you got to get licensed to get paid. Now, let's start off going through chapter 1. Life insurance. There's 2 types of life insurance, and the first one that you need to master and know backwards and forwards is term life insurance. Term life insurance, just like the name implies, is temporary. It lasts for a term period of time. So temporary period of time. Now we're not getting a degree in life insurance, teammates. We just want to know the material to the point where we can get the answer right, get the right answer on the test. So a lot of this is just word association. So when you see the word term, the answer is going to be temporary 9 times out of 10. If you see temporary, the answer is going to be term 9 times out of 10. Pick your right answer. Don't try to figure out why the other ones are wrong and go on to the next question. Term is temporary. It lasts for a period of time. It doesn't have any cash value or dividends or anything like that. And you only covered for during that period. Now, we have an acronym because we came up with our own notes to help people study. And the acronym to learn the different types of term life insurance is DIAL. D-I-A-L. DIAL. So the D stands for decreasing. The I stands for increasing. The A stands for annual renewable term, or ART, commonly called. And the L stands for level term. Now this is real simple, teammates. Now, if the name of the policy says decreasing, then it's just logical that the policy, the face value, what you cover for, is going to decrease. If the name of the policy says increasing, it's logical that it's going to increase. Annual renewable term is level, meaning the face amount or what you cover for stays level, but you renew it annually. That's why it says annual renewable. And then level term stays the same for the whole period you're covered for, 10 years, 20 years, 30 years on the policy. That's what we offer here, which is the best value in life insurance. Now, decreasing term. Far as a big part of passing tests is knowing what is the material that they want to know. What is it that the person that wrote the test, what do they want to make sure that you know? They want to make sure you know that decreasing term is most commonly used or most suitable when a client wants life insurance to cover a mortgage, to cover their mortgage or some type of loan. So if the question says something about Jack and Jill want a policy to cover their mortgage or loan or bank note, whatever kind of fancy way they come up with loan, they use the described loan and ask for decreasing term. Increasing term is most often associated with return of premium policies, meaning you're going to get not just the face amount that you had, but it's going to increase by the amount of premiums you paid. Return of premium policies. Annual renewable term can be tricky because what you cover for stays the same, but the premium goes up every year when you renew it. But even though the premium goes up every year when you renew it, as far as the test is concerned, annual renewable term is considered level term life insurance. So don't let that trick you up, because we got level term as a different type of policy altogether. But annual renewable term on a test is considered level term because the face amount stays the same. Level term insurance, the face amount stays level, but on a test, they want to make sure that you know that level term insurance is the most expensive the first year. Is the most expensive the first year. Annual renewable term is the cheapest the first year. But that does not mean annual renewable term is a better value, because over a 20-year period, if you get an annual renewable term and the premium goes up every year for 20 years, it is not a better value than a level term that's going to stay the same over 20 years. Your total cost over the 20-year period can end up being 5 times more on an annual renewable term than just buying a level term, even though the first year on a level term was higher. Now, this is term life insurance. Teammates, this is all you need to know. If you know this backwards and forwards, you should get it right on the test every time. Now, only other thing to learn about term life insurance is what happens at the end of the term. So if I got a 10-year policy, a 20-year policy, a 30-year policy, what happens at the end of those 10 years? Term life insurance is either going to be renewable or it's going to be convertible, or both. So we got an easy little saying for us to help us remember that. If you have a renewable policy, that means you have a policy that goes from term to term. So when I say renewable, you say term to term. It just goes together every time. Renewable, term to term, renewable, term to term, renewable, term to term. So if a client has a 20-year renewable term, if they buy it at 40, when they turn 60, it's guaranteed to renew it for another term. Now, convertible is term to perm. Term to perm, or perm is short for permanent insurance. So convertible is term to perm. Term to perm, term to perm. So like on the test, it may ask you, what type of term policy goes from one that does not build cash value to a type of policy that does build cash value? And that would be a convertible term, because the term policy does not build cash value, but when at the end, when it converts to a permanent policy, it does build cash value. These are the two ways, or the one way, that renewable and convertible life and term life insurance differ from one another. But they have two things that they have in common, that they are the same. They both, renewable and convertible policies, they both are guaranteed insurability. Guaranteed insurability means regardless of your health, you can get another life insurance policy. So you could have cancer, stroke, heart disease, kidney failure, brain tumor, diabetes, all that kind of stuff. It doesn't matter, no questions asked, you can renew your policy. And you can convert your policy. The other thing is, the other feature is it has an increase in premium based on attained age. Attained age is the age you are when you renew it or convert it. So if you get a 20-year policy, you buy it 20 years later, when you turn 50, when you renew it, the premium is going to be based on your age at 50, which is going to be higher. The same, renewable and convertible. Both of those are things they have in common, and this is how they differ. If you write this down every day and review this 10 minutes a day, you will learn this material and get your license. It is so much better to study 20 minutes every day than one day for 3 hours. Let me say that again. 20 or 30 minutes every day for 30 days or 1 week, 2 weeks, 3 weeks is infinitely better than 2 or 3 hours one day. Don't do like I did in school, where I didn't study at all and I would cram the night before. And then that may not work with this, because there's enough material, you need to look at it some every day. All right, term life insurance. And what's even better is to rewrite these notes every day. And that's even better, because if you rewrite it, and as you're writing it, it's going to stick every day. In a week, you'll have this stuff backwards and forwards. Now, this is term life insurance. The next type of life insurance is whole life insurance. Whole life insurance is, is the camera still on me? Whole life insurance is permanent. So term is temporary, and whole life is permanent. So whole life insurance got a few moving parts to it. So whole life is considered permanent. It builds a cash value inside of the policy. It has a level premium to age 100. Our acronym for whole life insurance is WELLS. WELLS. The W is for a traditional, straight life, pure life policy. All those three terms are interchangeable. If that on the test, if it says Jack got a straight life policy, or he got a traditional life policy, or he got a pure life policy, it's all the exact same thing. A straight life, traditional life, or pure life policy, all of them are going to have the same feature. It's going to have a level premium to age 100. It's going to build cash value after 3 to 5 years. And it's going to endow, meaning the cash value is going to equal the face amount at age 100. You die, if a person buys a whole life policy, they're paying for two things and they only getting one. They're paying for whole life, they're paying for the face amount of what they're covered for, and they're paying for a cash value that's going to accumulate inside the policy. At death, your family only gets the face amount, insurance company keeps your cash value. So you're paying for two things when you're only getting one. Now, the other type of whole life insurance is an endowment policy. An endowment policy builds cash value faster than a traditional life. It's the easiest question on the test because the first letter of endowment is E and the first letter of expensive is E. And that's all you gotta know. First letter of endowment is E, the first letter of expensive is E. So if the question says any version of Jack wants to raise money to build a new roof on the church, he can afford to pay more. When you see more, it's an endowment. Jack wants to save money for retirement, he can afford to pay more. The answer is endowment. Jack want to do anything dealing with raising money, scholarship fund, new roof on the church, build cash value faster for retirement. Any version of paying more than or the most expensive, the answer is going to be endowment. It might have some other stuff like endow at age 65 or endow at age 50. Don't worry about all the other stuff they're adding. The key word is expensive and endowment. Always go together. Pick that, you'll get it right every time. The next is limited pay. A limited pay policy, you only pay for a certain period of time, but you still covered till you turn 100. In the insurance world, like my full name, Christopher Michael Durham, that's all three names my mother gave me. For our study purposes, a limited pay policy has a full name, and the full name is limited pay is 10 pay life, 20 pay life, and paid up at 65. They all go together. Limited pay is 10 pay life, 20 pay life, paid up at 65. 10 pay life, 20 pay life, paid up at 65 is limited pay. If you put it all together every time, you're going to get it right every time. You don't even have to think about it. The question will take you 10 seconds to answer. Limited pay is 10 pay life, 20 pay life, paid up at 65. When you read the question and you see the word limited pay, you automatically add 10 pay life, 20 pay life, paid up at 65. If you see in the question 10 pay life, 20 pay life, or paid up at 65, then the answer is going to be limited pay. They always go together. You say all four names together, you're going to get it right every time. Once again, teammates, we are working on building a business in the richest, obviously we're in the money industry. They got all the money. We're building a business there. Let's not take this stuff lightly. We got to get this down. Next is limited benefit. Limited benefit only pays for certain causes, like a cancer policy or something. Certain causes. Example would be a cancer policy. Then, lastly, you got single premium. We know single is one. A single premium policy has one premium. It's the only policy that builds immediate cash value. And why does it build immediate cash value? Because you made one lump sum payment all at one time. So if you call up the Snake Farm agent and tell them, hey, I got $15,000, I want to policy life the rest of my life, they're going to play with their numbers and come up and say, all right, well, give us the whole $15,000 and you're going to have $100,000 for the rest of your life. Which in my opinion would be terrible, because you can, instead of giving them $15,000, you give them $100 and get a 20-year term and invest your other $14,900 for the next 30 years and end up with $1 million. But that's a whole nother meeting on why people give all our money to the insurance company. Because we just don't know that Invesco got $907 billion. We just mix in our money with $907 billion, and we're going to end up, when they get to $1 trillion, we're going to be right there with them. All right, single premium, builds immediate cash value, one lump sum payment. All right? That's whole life. We got to know it backwards and forwards. The next type of policy is a family policy. On the test, they got two different types of family policies. You got a family maintenance policy, and you got a family income policy. Family maintenance and family income. Now, this we went over everything. It was term life insurance. This is everything we need to know about whole life insurance. We got to know those two backwards and forward. That's the foundation of the material. If you don't know these two, when they start putting them together like this combination policy I'm explaining to you, you're going to be guessing. You need to know term life and whole life backwards and forward so you can add them, when they add them together and these other types of insurance, you'll be able to get the answer right. Family policy. You got family maintenance and you got family income. They are combining two types of life insurance. A family maintenance policy combines whole life insurance and level term. A family income policy combines whole life insurance and decreasing term. It's easy to get it right on the test because if I'm maintaining something, I'm keeping it level. If I'm maintaining something, I'm keeping it level. So when you're reading the question and it says, Jack got a family maintenance policy, your hand should come off your desk and start doing this. Because I know it's level. Pick the right answer and go on to the next question. Family maintenance is level. If I'm maintaining something, I'm keeping it level. If I'm maintaining something, I'm keeping it level. So if there's only two options and you know one, you automatically know the other. Because if maintenance is level, then decreasing, income has got to be decreasing. It's that simple. Now let me give you a real life scenario. Jack and Jill have got a family maintenance policy. Jack died, Jill's going to get a lump sum and a monthly check for 20 years. A lump sum and a monthly check for 20 years. Now, so a family maintenance policy is always 20 years. On the test for sure. Now, let's say if Jack and Jill got a family income policy. Jack died, Jill's going to get a lump sum, and she's going to get a monthly check for the remaining number of years that she has left on that 20-year rider. You got to subtract the number of years she's had the policy already. So they had the policy already. So if Jack died, Jill's going to get a lump sum. Let's say they had the policy for 4 years, she's going to get a check for 16 years. If Jack died, they've had a family income policy, and Jack died in 9 years, she's going to get a lump sum and a monthly check for 11 years. But the only thing you got to do, teammates, is be able to subtract from 20 and get it right every time. In fact, if you got to do any math whatsoever, then you know the answer is family income, because family maintenance is always 20 years. It's that simple. So when you read the question and it says, Jack had the policy for 7 years and 6 months. How long will she get an income from? Well, 7 years and 6 months from 20 is 13 years and 6 months. So that's what she would get. That's simple, teammates. Whole life, now family income. The next type of policy, I'm going this way, is universal life insurance. Universal life insurance is even more tricky. A universal life insurance policy has two components as well. A universal life insurance policy has two components. It has a life insurance component and it has a cash value or cash component to it. The insurance component to a universal life is annual renewable term. Remember, we discussed that earlier. It lasts for 1 year and the premium goes up. The cash value or the cash account in a universal life insurance policy works similar to the cash value in a whole life policy. See, so now when we went discussing term life insurance, term is synonymous with temporary. Whole life is synonymous with permanent. Universal life is synonymous with the word flexible. When it says flexible premium, the answer is universal life. You don't even have to read the rest of the questions. Flexible premium adjustable life. So let's say in a whole life policy, it builds cash value and you can borrow on the policy. In a universal life, they got fancy and come up with different way to save borrowing your money, and they call it partial withdrawals or partial surrenders. So you don't borrow the money, you do a partial withdrawal or partial surrender. As far as I can tell, it works exactly the same way. It reduces your face amount by how much the loan is or whatever you withdrew, and if the cash value ever goes to zero, the policy lapses. Got it? Universal life insurance, annual renewable term cash account. The cost of insurance, if you get the policy at 30, by the time you get 70, the cost of insurance goes up every year. When the cost of insurance goes up, the cash value is going to go down. When it gets to zero, the policy is going to lapse. Life is three other, features to a universal life that's going to be on your test. A universal life policy has two death benefits. It has A and B. A is face amount only or level. B is both face amount and the cash. B is both, face is level or face amount only. A is face only, B is both. It's that simple. On the test, if it says Jack and Jill got a flexible premium adjustable life policy that has a death benefit that is level, what type of policy does he have? He has a universal life policy death benefit A. Just like that. If he says Jack got a flexible premium policy that has a death benefit that increases as the cash value increases, what kind of policy does he have? He has a universal life policy with death benefit B, because the face amount is increasing as the cash value increasing, meaning the beneficiary is going to get both. Target premium. Target premium in a universal life policy is a flexible premium policy. So the cost of insurance isn't the amount you have to pay. Just as long as there's enough cash value to cover the cost, you can pay more or less, or nothing at all. But the insurance company knows how much you need to pay to keep it in force. That's what target premium is. That's the amount you need to pay to keep the policy from lapsing or keep it in force. Got it? And then the last one, feature you need to know, is corridor of insurance. Corridor of insurance saves the tax advantages. In a universal life policy, as the cost of insurance goes up, the insurance company can automatically increase your death benefit. Let's say if you had $100,000 in life insurance, you're paying $100 a month, they can automatically tell you have 100, give you 200 or 300. That way they are taking more of your premium to cover the cost of insurance, because if the premiums ever exceed the premiums paid, then you lose the tax benefit. So without having to remember all the why-tos or why it works this way, you can get it right on the test every time, because corridor of insurance. Corridor of insurance, not cost of insurance. Corridor of insurance. On the test, it saves tax advantages. The first letter of advantage is A. It only goes to death benefit A. Got it? This is universal life. You write down these notes every day, 20 minutes, 30 minutes max, every day for a week. You're gonna get this. You'll be finished with the test in 30 minutes. The next type of policy on the test is, make sure I don't leave any out. You got joint and survivor. So the next is joint life. Joint life and you got joint and survivor. It's a very simple concept, but on a test they can make it seem tricky. Joint life insurance pays at the death of the first person, or first to die. A joint and survivor policy is going to pay at the death of the second person, or second to die. Jack and Jill got a joint life policy. Jack died. Jill gonna get the death benefit. She not covered no more, policy ends. Jack and Jill got a joint and survivor policy. Jack died. Jill not gonna get anything. Jill died and the kids get something. Now on the test, now that sounds simple, but on the test, they'll make that sound so tricky you can't even figure out what they're talking about. But this is how you pick it out every time. They're gonna say some version of Bob and Mike are business partners. They have a business. They want a policy to cover the life of both of them to cover their debt, blah, 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 should one of them pass. The key word that you know, it is going to be, this is the type of policy they're asking about. The key word in both of these is both. When you see the word both, it's one of these, that's the answer. They want, Jack and Jill want a policy to cover the life of both. It's going to be, you know it's either joint or joint survivor. Now you only got to figure out if it's first to die or second to die. But both, because it's insuring the lives of two people paying the death of one. Later on, we start talking about annuities. You have joint and survivor annuity. Same concept, except the income stops at the death of the first one or stops at the death of the second one. But it's two people involved, either first or second. Then you can get it right every time. Next is interest sensitive. Just in a whole life policy, it has a guaranteed cash value. An interest sensitive policy, the cash value can vary based on the company's performance. Also, you can have adjustable life. Adjustable life, you can change three things. P, C, P. You can change the type of plan, you can change the coverage period, and you can change the premium period. You cannot increase the policy. You can't change the insured. It'll throw you off on a test with that. You can only change the type of plan, coverage period, or premium period. Payer benefit, modified life, and graded life. And if the variable, it's going to be everything in chapter 1, or 90% of everything you need to know. It's enough for you to pass, that's for sure. All right, let's talk about payer benefit. And a payer benefit if the payer or the parent or guardian or custodian, whoever paying for the policy for the child, dies or becomes disabled, it will waive the premium until the child becomes an adult. So payer benefit doesn't increase the death benefit, it waives the premium. Juvenile life is any insurance on the life of a minor. And modified life insurance has one increase in premium, then it's level to 100. So you got one increase in premium in the first 3 to 5 years, then it's level to 100. So modified has one increase. How you get it right on the test? Every time, the first 2 letters of modified is MO. MO stands for move once. Just that simple. And then the other type is graded. Graded life has several increases in the first 5 to 7 years, then it stays level. Just like in school, it's not good to repeat the same grade. You gotta have more grades. Got it? Just like that. And the last one is variable. Variable life works just like a whole life policy, except in a variable life insurance, the